They don't tell you the game has referees. They don't tell you those referees can change the rules mid-play. And they definitely don't tell you that when silver starts moving too fast in the wrong direction for certain players, a single memo can trigger a wave of forced selling so violent it looks like the world ended. Except the world didn't end. The rules just shifted. And if you don't understand the difference, you'll keep getting blindsided by the same playbook over and over again. This morning, silver didn't collapse because someone discovered a mountain of new supply. It didn't crater because solar demand vanished or EVs suddenly stopped needing conductors. Silver fell because the CME group, the exchange where futures contracts trade, raised margin requirements. And when margin requirements rise, traders using leverage face an immediate choice. Post more cash or get liquidated. Not tomorrow, not next week. Now. And when thousands of leveraged positions hit that wall simultaneously, you don't get orderly selling, you get a stampede. Welcome back. I'm about to show you exactly how this machine works, why it keeps happening at the most convenient moments, and what actually matters when the smoke clears. But first, do me one favor, hit subscribe. These events don't announce themselves in advance, and the next one is already being loaded into the chamber. You'll want the alert when it fires. Now let's break down what a margin hike actually does, because most people think they understand leverage until it liquidates them. A silver futures contract doesn't require you to pay for the metal up front. You're not buying 5,000 ounces of silver and parking it in your garage. You're controlling 5,000 ounces with a fraction of their value posted as collateral. That collateral is called margin. It's essentially a performance bond. The exchange is saying, prove you can survive some volatility and we'll let you play. Here's how it works in practice. There are two margin numbers that matter, initial margin and maintenance margin. Initial margin is what you need to open a position and hold it overnight. Maintenance margin is the absolute minimum you must keep in your account to avoid a margin call. Let's say initial margin is $10,000 and maintenance is $8,000. You open a position with 10 grand. Price moves against you. Your account drops to 7,000. Boom. Margin call. Your broker isn't asking nicely. Your broker is telling you to wire cash now or they're closing your position at market price. And market price during a cascade can be brutal. When prices move against you, that margin gets tested constantly, every tick, every minute. If your account falls below that maintenance threshold, you get a margin call. You either deposit more cash immediately or your broker closes your position. No negotiation, no grace period, no "can I have until Monday" conversations. The broker isn't your friend in that moment. The broker is protecting themselves from your potential default because if you blow up and can't cover, the broker is on the hook. So they cut you loose fast and without mercy. Now here's where it gets nasty. When the exchange raises margin requirements, they're changing the rules overnight. What was enough collateral yesterday is suddenly insufficient today. Your broker recalculates. If you're short on cash, you're getting liquidated whether you like it or not. And here's the kicker. It's not just you, it's everyone in the same boat. Multiply one forced liquidation by hundreds or thousands of positions, and you've got a cascade. Price drops, stops trigger, stops become market sell orders, market sells push price lower. Lower prices stress more accounts get liquidated. It's a feedback loop. And it doesn't stop until the forced sellers run out of positions to dump or until buyers with real capital step in to catch the falling knife. That's why these drops look like cliffs on the chart. There's no breathing, no gradual negotiation, just gravity. And the timing? Oh, the timing is never random. This latest margin hike hit during the tail end of the year when liquidity is naturally thinner. Banks are closing books. Traders are on vacation. Institutional desks are running skeleton crews. Thin liquidity means the same amount of selling creates bigger price moves. It means stops get run more easily. It means the cascade builds faster than anyone can react. So when you see a sharp drop during a holiday week, ask yourself, is this coincidence or strategy? Because the people running this game understand exactly when the market is most vulnerable. Let's talk about who actually gets hurt, because it's not distributed evenly. Big institutions have credit lines. They have treasury departments. They can wire millions in minutes to meet a margin call. Retail traders can't. Small funds can't. Independent speculators definitely can't. When your broker calls at 9 a.m. demanding $50,000 by noon and your bank is closed for the holidays, you're not meeting that call. You're getting sold out. The market doesn't liquidate based on who's right. It liquidates based on who has the least liquidity. And that structural unfairness is baked into the system. The rules favor size, they favor speed, they favor institutions. If you don't have instant access to capital, you're playing a different game with different consequences. But here's what most people miss. This isn't really about silver. It's about paper claims on silver. When a futures contract gets liquidated, no actual metal changes hands. No bars leave a vault. No ounces get refined. What moves is a contractual obligation. A promise. And because the futures price is the benchmark that everyone watches, those paper promises can drag the screen price down even when the physical market stays completely unchanged. You can have a world where the chart screams panic, while wholesalers, mints, and dealers are holding steady or even raising premiums. That's not a contradiction, that's structure. The paper market and the physical market are two different animals. They influence each other, but they're not the same thing, and when they diverge, that gap becomes information. Now, the official story for margin hikes is always the same. Risk management, volatility is up, so we're protecting the integrity of the market. And that explanation isn't entirely false. Exchanges do need to manage default risk. But here's what they don't say out loud. Risk management and price control are the same action with different PR. When you raise margin, you reduce buying power across the board. You force some positions to close. You change the flow of capital. And when you change the flow, you change the price. So yes, it's risk management, but it's also a pressure release valve. And if you're on the wrong side of that valve when it opens, you learn very quickly that the market doesn't care about your thesis. Let me show you the pattern because this isn't new. This is a rerun. In 1980, silver went absolutely parabolic. The Hunt brothers were accumulating massive positions, squeezing the market, and the price was running wild toward $50 an ounce. The exchange watched this unfold and then responded by changing the rules mid-game. They announced a new policy, Silver 7. It restricted new long positions and raised margin requirements multiple times in a short window. First hike, second hike, third hike, each one tightening the noose. The rally broke. The leveraged longs got destroyed. Fortunes evaporated. The story became a cautionary tale about greed, manipulation, and speculation. Everyone talks about the Hunt brothers getting crushed, but the mechanism that crushed them was mechanical. The exchange changed the terms. The exits were forced, the shorts got relief, the longs got annihilated. Fast forward to 2011. Silver surged again during the post-financial crisis money printing era. People were worried about currency debasement. Silver ran from $30 toward $50. As it approached those psychological highs, guess what happened? Margins got raised. Not once, not twice, 5 times in 8 trading days. Each hike was positioned as risk management. Each hike shook out more traders. Each shakeout fed the next leg down. The price went from nearly $50 to $30 in a matter of days. It wasn't one clean sell-off. It was a sequence of margin-induced squeezes that created a cascading liquidation. Same playbook. Different decade, different excuse, same result. And now, late 2025, we're watching it happen again in real time. Silver rips higher on the back of supply concerns, industrial demand, and macro uncertainty. The price touches the mid-80s. And then what? Margins get raised. Once, twice. The latest increase lands right as year-end liquidity thins out and traders are closing their books. Convenient timing, wouldn't you say? Same playbook, same outcome. Leveraged positions forced to sell. Price craters, headlines scream. The narrative flips from scarcity to speculation. But the mechanics never change. So here's the question nobody wants to ask directly. Are these hikes purely about risk control, or do they also function as a convenient tool when rallies start threatening big short positions? I'm not here to accuse anyone of conspiracy. I'm here to point out incentives. If major institutions are heavily short and a sharp rally is causing them pain, a margin hike that forces long liquidation provides relief. It creates a window to cover. It buys time. It reduces pressure. That doesn't require coordination. It just requires humans acting in their own interest. When you're underwater, you want a lifeline. And if changing a rule provides that lifeline, well, rules get changed. But let's get back to what actually matters, the fundamentals. Because no margin memo can rewrite the laws of supply and demand. No rule change can make silver less essential to the modern economy. Silver is not just a shiny metal people hoard for apocalypse scenarios. It's a critical industrial input that's woven into the infrastructure of modern life. And the demand is real, measurable, and growing. Solar panels need silver for conductivity and durability. Each panel uses a small amount, but when you're installing gigawatts of capacity globally, small amounts compound into massive totals. The solar build-out isn't slowing down. It's accelerating. Governments are mandating renewable targets. Corporations are buying power purchase agreements. China, India, the US, Europe, everyone is racing to expand solar capacity, and every single panel needs silver. Electric vehicles use silver in power electronics, battery management systems, charging infrastructure, and electrical contacts. The average EV uses about twice as much silver as a conventional combustion engine vehicle, and EV production isn't a niche market anymore. It's mainstream. Manufacturers are retooling entire factories. Governments are banning new combustion vehicle sales by certain dates. The transition is happening whether you believe in it or not, and that transition runs on silver. Data centers, the backbone of cloud computing, AI processing, and digital infrastructure, use silver in connectors, switches, and high-performance components. Every time someone talks about AI scaling or data center expansions, they're indirectly talking about silver demand. Grid modernization uses silver in switching gear, transformers, and control systems. The aging electrical grid needs massive upgrades to handle renewable integration, EV charging loads, and increased electrification. Those upgrades require conductive, reliable materials. Silver fits that requirement better than almost anything else. This demand is real. It's not speculative. It's not driven by sentiment or hope. It's embedded in purchase orders, manufacturing processes, and government mandates. You can't fake this kind of demand. And here's the uncomfortable truth about supply that makes this whole setup fragile. Most silver doesn't come from primary silver mines. Roughly 70% of silver production comes as a byproduct of copper, zinc, lead, and gold mining. Think about what that means. When a mining company is deciding whether to expand production or open a new project, they're not looking at the silver price. They're looking at copper prices, zinc prices, gold prices. Silver just comes along for the ride. That means silver production doesn't respond quickly to price signals the way a primary commodity does. If silver doubles in price, you don't magically get double the mine output 6 months later. The pipeline is measured in years, not months. Permitting takes years. Environmental studies take years. Capital expenditure takes years. Construction takes years. And even once a project is online, ore grades have been declining across the board. You're processing more rock to get the same amount of metal. Add political risk to the equation. Nationalization threats, export restrictions, mining code changes, community opposition, water rights battles. Every producing region has its own challenges. So when the world is consuming more silver than it's producing, which has been the case for multiple years now, inventories get drawn down, stockpiles shrink, and when inventories shrink, the system becomes fragile and vulnerable to shocks. Add geography to the equation. A huge chunk of silver refining happens in Asia. A huge chunk of manufacturing happens in Asia. A huge chunk of end-use demand happens in Asia. When physical metal flows toward those end users, it stops being available to satisfy paper contracts in Western exchanges. And if major exporting countries tighten export rules or prioritize domestic industry, global availability can tighten further without any headline announcing it. That stress doesn't show up instantly in a futures chart. It shows up later in delivery issues, rising premiums, and warehouse drains. This is why silver can look calm on the surface and be tense underneath. The paper price can stay flat while the physical market is quietly tightening like a spring. So when people ask, does today's crash mean the rally was fake? The answer is no, the rally wasn't fake. The rally was leveraged. And leveraged rallies are fragile. They're vulnerable to margin shocks. That's not bullish or bearish by itself. It's just a feature of how futures markets work. The real question is what happens after the leverage gets flushed out. That depends entirely on whether physical demand stays strong and whether inventories keep shrinking. And you don't answer that question by watching a single day's candle. You answer it by watching 4 specific signals. These signals separate real shifts from temporary noise. These signals tell you whether the selling was forced or fundamental. First signal, physical premiums. This is the gap between the futures price and what people actually pay for real metal. Coins, bars, wholesale lots. If the paper price drops $5 but premiums don't budge or actually widen, the physical market is sending you a message. The message is that real buyers still want real metal, and they're willing to pay above the screen price to get it. That divergence tells you the selling was paper, not physical. It tells you the liquidation was forced, not voluntary. Watch the premiums at major dealers. Watch the premiums in different regions. If they hold firm or increase while the futures price crashes, that's information. Second signal, inventory levels at major warehouses and exchanges. Not the rumors, not the Twitter speculation, not the guy who knows a guy who works at a vault. The actual reported ounces at COMEX, London, Shanghai. Are registered ounces draining? Are eligible stocks being drawn down? Are warehouse receipts declining? This data gets published. You can track it. And when inventories decline during a price crash, that's a massive red flag. It means the physical market isn't believing the paper price. It means real metal is leaving the system even as the chart looks ugly. That's how bottoms form. Not with fanfare. With quiet accumulation while everyone else is panicking. Third signal. Delivery behavior in the futures market. Every futures contract has an expiration. When a contract expires, traders have choices. They can roll to the next month, meaning they close the current position and open a new one further out. They can close entirely. Or they can stand for delivery, meaning they actually want the metal. Watch how many contracts are standing for delivery. Watch whether that number is increasing or decreasing. Watch whether the delivery process is smooth or strained. If more contracts are demanding physical settlement, that's real demand pressing against paper supply. If the delivery process shows stress, backlogs, or delays, that's the system showing cracks. Delivery is where theory meets reality. It's where paper promises either deliver or break. Fourth signal. Global price alignment across different markets and regions. Silver trades in different currencies and different physical locations. London, New York, Shanghai, Mumbai. If the US futures price drops but Asian physical prices stay elevated, arbitrage will notice. Traders will buy cheap futures, take delivery, ship the metal, and sell at the higher physical price. That arbitrage activity acts as a leash. It limits how far paper and physical can diverge before capital flows in to close the gap. Watch for that alignment. If it's tight, the markets are functioning normally. If it's wide and persisting, something is structurally broken. Either liquidity is frozen, delivery is impaired, or the paper market has lost credibility. Any of those scenarios is a bigger story than one day's margin hike. Now let's talk about what today teaches different types of traders. If you were leveraged long and got liquidated, you just paid tuition for the most expensive lesson in commodities. You can be completely right on the fundamentals and still get destroyed by mechanics. The market can force you out before you're proven right. That's not unfair. That's how leverage works. If you don't have room in your account to survive a margin hike, you don't have a position, you have a timer. On the other hand, if you were holding physical or trading without leverage, you learned something different. Volatility is noise unless it fundamentally changes the supply-demand picture. A margin hike doesn't create new silver. It doesn't erase industrial demand. It doesn't shut down solar factories. It changes collateral rules. That's it. And that brings us to the psychological game that always follows these events. The narrative war, because price action is only half the battle. The other half is perception. You're going to see narratives flip instantly across financial media, social platforms, and commentary channels. The rally is over, the top is in, speculators got washed out, silver is going back to 20, the bubble popped. They'll speak with absolute certainty because certainty sells, fear sells, panic sells. People don't click on market shows, mixed signals, headlines. They click on silver crashes, here's why you should be worried, headlines. But certainty in markets is usually theater. The people pushing those narratives loudest often have the most to gain from your panic. They don't need you to believe silver is worthless forever. They just need you to panic long enough to sell at the bottom. They need you to hand them your position at a discount. They need you to stop bidding so they can cover shorts, accumulate physical, or simply reduce their own stress. So don't anchor your entire outlook to one day of violent price action, especially when you can point directly to a mechanical cause. Anchor to the setup instead. Did today's margin hike create more silver in the ground? No. New mines didn't magically appear. Did it reduce solar panel production? No. Factories are still running. Did it erase the supply deficit? No. The consumption-production gap is still there. Did it eliminate industrial demand? No. EVs still need conductors. Data centers still need components. The grid still needs upgrades. What changed? Some leveraged traders got forced to sell. That's the extent of it. The rest is noise designed to shake your conviction. Now, what should you expect next? Because understanding what happened is only useful if you understand what typically comes after. Expect more volatility. This isn't over. After forced liquidation, markets often whipsaw violently. They bounce hard as bargain hunters step in. Then they dip again as weak hands who bought the first bounce panic out. They test everyone's conviction repeatedly. They hunt for stops in both directions. Algorithms scan for liquidity pockets and trigger them. The market wants to know who's committed and who's just gambling. It punishes anyone who thinks one move equals certainty. Expect coordinated attempts to shake confidence. You'll see headlines emphasizing the downside. You'll see analysts suddenly lowering targets. You'll see commentary about how silver always does this and bulls always get trapped. Some of it will be genuine analysis. Some of it will be positioning. Some of it will be people who missed the move talking their book, filter everything through incentives. Who benefits if you sell here? Who benefits if confidence breaks? Who benefits if physical premiums drop because retail backs away? But here's the critical part. Expect opportunity to show up exactly where fear is most concentrated. This is a universal market truth. The best opportunities hide in the moments of maximum stress. But, and this is crucial, only if the underlying fundamentals remain intact, if physical premiums hold, if inventories keep draining, if delivery demand stays strong. If those signals break, the story changes and you need to reassess. But if they hold, today's forced selling may have just handed a discount to the exact buyers who actually need ounces for manufacturing, for strategic reserves, for long-term accumulation. Not traders who need opinions, buyers who need metal. This is where patience becomes a real edge that compounds over time. The majority of traders are emotional, over-leveraged, and reactive by nature. They sell the lows because the chart feels like pain, and pain demands action. The disciplined buyer does the opposite. The disciplined buyer watches the constraints that actually matter. not the candles that create emotional responses. The disciplined buyer understands that in a small market like silver, it doesn't take much forced selling to smash price temporarily, and it doesn't take much real buying to send it flying in the other direction. That's the nature of the beast. Explosive in both directions. Thin liquidity cuts both ways, which is exactly why amateurs get destroyed repeatedly while professionals accumulate wealth. Amateurs think price equals truth in the moment. Professionals know price can be pushed, manipulated, and distorted by structure, especially when the market is thin, year-end liquidity is light, and the game is structurally rigged towards size and speed. Now, let me be very clear about something. I'm not telling you what to buy. This is education, not personal financial advice. Your risk tolerance is yours. Your account is yours. Your decisions are yours. But I am telling you what today actually was. Today was a rules event. And rules events are where silver separates people who understand the game from people who are just gambling. Today's price action didn't rewrite the fundamental story. It rewrote who's holding the ounces. And if you understand that distinction, you're already ahead of 90% of the market. So here's the bottom line. Silver fell hard today because the CME raised margin requirements, forcing leveraged traders to liquidate. The move looked dramatic because thin year-end liquidity amplifies cascades. But the move didn't change the industrial demand for silver. It didn't change the supply deficit. It didn't change the geographic concentration. It didn't change the fact that inventories have been draining. What it did change is who's in pain and who's in position. The leveraged longs are out. The patient buyers just got a discount. And the next chapter won't be written by today's headline. It'll be written by premiums, inventories, delivery behavior, and whether the physical market stays stubborn while the paper market freaks out. If you want to catch the next breakdown the moment something like this happens again, subscribe now. These rule shifts don't come with advance notice. They don't send you a calendar invite. They just happen. And the people who understand them in real time have a massive advantage over the people who find out 3 days later on social media. Don't be late to the next one. And one last thing. Tell me straight in the comments. After watching this breakdown, do you see today's crash as a fundamental shift or a mechanical flush? Because your answer to that question will determine whether you're buying fear or selling into it. Choose wisely.